Every central bank swears it can tame inflation without hurting anyone. Every politician promises price stability without sacrifice. And every time inflation really gets out of control, history shows something very different. In the late 1970s, prices in the United States were spiraling, wages were chasing them, and faith in the dollar itself was starting to crack. Gas lines stretched for blocks, mortgages carried double-digit interest rates, and the cost of simply existing rose faster than paychecks could keep up. It felt less like an economy and more like a slow-motion disaster. Then one quiet, towering figure walked into the Federal Reserve and did something almost no one believed was politically survivable. He pushed interest rates to levels that looked insane, watched the economy slam into a wall, and refused to back down. Inflation broke, but so did a lot of other things. The question isn't just how he did it. The real question is why breaking inflation meant breaking almost everything else first, and what that trade really bought for the decades that followed. Before the shock, inflation didn't arrive as a monster. It arrived as a bad habit. In the 1960s, the United States tried to buy two dreams at once: an expensive war abroad and an ambitious social program at home. Guns and butter, victory in Vietnam, and the Great Society. The problem was simple and predictable. The political appetite for spending was far greater than the appetite for raising taxes. Voters loved benefits and hated the bill. So the gap between what the country wanted and what it was willing to pay for had to be bridged another way. That bridge was a money creation. At first it seemed harmless. A little more government spending, a little more tolerance for price increases, 3% inflation, 4%, then 5%. Uncomfortable, but still manageable. Wages were rising, growth was decent, and the pain felt distant. Inflation looked like the price of progress, not the beginning of a crisis. Beneath the surface, the anchors that held the system together were already slipping. After World War II, the global monetary order had been built on a simple promise. The dollar would be as good as gold, and other major currencies would be anchored to the dollar. It was a structure meant to prevent the chaos of competitive devaluations and runaway inflation that had haunted the early 20th century. By the late 1960s, that promise no longer matched reality. The United States had printed and promised more dollars than it could reasonably redeem with gold. Foreign governments noticed. Some began converting their dollars into metal and demanding delivery. Tee strain became impossible to hide. In 1971, the final link snapped. The dollar was severed from gold. What had been an anchor turned into a memory. From that moment on, money became something different. Not a claim on a fixed quantity of metal, but whatever governments and central banks decided it was, issued in whatever quantity they felt was necessary. At the same time, oil-producing nations realized just how much leverage they had. A series of oil shocks in the 1970s slammed the world with energy prices that seemed absurd. The cost of moving goods, heating homes, and running factories exploded. That fed directly into the price of everything else: food, manufactured goods, transportation, housing. Inflation was no longer a local problem. It was imported with every barrel of crude. By the late 1970s, inflation had stopped being just an economic statistic. It had become a way of life. Prices weren't only rising, people expected them to keep rising. Workers walked into wage negotiations, assuming that anything less than a big raise meant falling behind. Businesses increased prices, not because they were greedy, but because they were certain their own costs would jump next month. Landlords baked future inflation into every lease. Savers watched the value of their money erode in real time and rushed into anything that might hold value better than cash. Inflation had left the textbooks and moved into psychology, and once it lives in people's expectations, it becomes something far more dangerous. When everyone believes that the value of money will fall tomorrow, they rush to get rid of it today. Spend faster, borrow more, lock in hard assets, avoid holding cash. The system begins to spin. The Federal Reserve was supposed to stop that spin. For years, it hesitated. Each attempt to tighten policy came with a flinch. Rates would rise a bit, markets would protest, unemployment would tick up, and the pressure to retreat would win. Inflation would cool slightly, then come back hotter. The institution lost credibility. The public simply stopped believing that the central bank would do what was necessary. In August 1979, that changed. Paul Volcker didn't arrive with banners or slogans. He arrived with a battered briefcase, a towering frame, a low voice, and a cigar. He understood something uncomfortable that almost no elected leader wanted to say out loud. Deeply entrenched inflation is not defeated with polite intentions. It is defeated with pain. Real, visible, widely felt pain. When Volcker took the chair, inflation was in double digits. The Fed's reputation was nearly gone. Markets had learned to assume that any burst of toughness would be temporary. Politicians would scream, voters would panic, and the central bank would blink. To break inflation, that pattern had to die. The strategy Volcker chose was simple in design and brutal in effect. Instead of tiptoeing interest rates higher by tiny increments, he changed the entire operating framework. The central bank shifted its focus toward controlling the growth of the money supply. and allowed interest rates to move as high as necessary to slow that growth. There would be no comfortable ceiling. Where interest rates had to go took almost everyone by surprise. Through 1980 and 1981, short-term rates didn't just rise, they soared. The benchmark federal funds rate climbed into the mid-teens and kept going. At the peak, it brushed levels around 20%. The prime rate, the rate banks charged their most creditworthy customers, went even higher. Mortgage rates for ordinary families buying homes shot into the teens. Imagine sitting across from a loan officer and hearing that the rate on a 30-year mortgage would be 15% or more. Not on a credit card. On the roof over a family's head. This wasn't an accident or an oversight. That was the point. Inflation was a fire embedded in the structure of the economy, in contracts, in expectations, in habit. Volcker decided that sprinkling water on the curtains would not be enough. The house had to be soaked from the foundation up, even if furniture, carpets, and some of the walls were ruined in the process. The flood spilled out of the financial system and tore through the real economy. Industries that relied heavily on credit, construction, autos, agriculture, were hit hardest and first. Home builders watched orders vanish as potential buyers stepped away, unable to afford monthly payments. Car dealers saw inventory sight unsold as financing costs crushed affordability. Farmers with variable loans faced interest burdens that made profitable operations suddenly impossible. Unemployment surged into double digits. Bankruptcies rose. Foreclosures climbed. For many, this didn't feel like abstract policy. It felt like a decision made in a distant boardroom that had reached into their lives and flipped the switch off. The anger was real. Farmers drove tractors to the Federal Reserve and circled its headquarters in protest. Small business owners mailed in fragments of lumber to symbolize broken housing markets. Newspapers filled with stories of families losing homes, workers losing jobs, and communities hollowed out by an invisible force with an interest rate. Behind all of that visible pain, something targeted was happening. Volcker was not just trying to make prices stop rising. The goal was to break the underlying belief that inflation would always be high and always be tolerated. The habit of expecting double-digit price increases had to be shattered. For workers, that meant learning that automatic big raises were not guaranteed. For companies, it meant realizing consumers would no longer be able or willing to absorb endless price hikes. For bond markets, it meant understanding that the central bank would accept short-term recession and unemployment to defend the currency's long-term value. Beliefs like that do not change at a press conference. They change when the present becomes an example, when the population sees that the rules really have shifted, and that the authorities are willing to enforce those rules even when the consequences are ugly. That is why Volcker-Au's shock felt less like a monetary policy and more like a national cold turkey program. An addiction to easy money and tolerable inflation had to be broken. The withdrawal was ugly. Slowly, it worked. Inflation is always part math and part expectation. High rates choked off new borrowing, cooled demand, and slowed the speed at which money changed hands. As businesses found it harder to pass on costs, the momentum behind price increases weakened. Workers, facing higher unemployment and fewer alternatives, accepted smaller wage gains. Contracts began to reflect lower expected inflation. The fever broke gradually, then decisively. By the mid-1980s, the United States had entered a new regime. Inflation had fallen sharply. More importantly, the expectation of permanently high inflation had been crushed. The central bank's reputation had been rebuilt on something harder than words. Demonstrated willingness to cause short-term pain in defense of long-term price stability. That is the version of the story usually told. Tough central banker, bold rates, inflation slain, lesson wrapped. But underneath that clean narrative sits a more complicated reality. A question lingers: who paid the bill for this victory and who reaped the rewards of the world it created? High interest rates are not neutral. They take from one side of the balance sheet and give to the other. On one side stood borrowers, homeowners, farmers, small businesses, heavily indebted companies, and governments rolling over their debt. For them, Volcker's world was a hammer blow. Monthly payments exploded. Projects no longer made sense. Loans that had been manageable at lower rates turned into traps. On the other side stood savers and lenders, those holding cash, those able to buy government bonds at enormous yields, those with the discipline and resources to wait out the storm. For them, this period offered something few crises ever do: extremely high returns on the safest assets available. Treasury securities, deposits, high-grade bonds, all offered yields that look almost unreal from a modern perspective. Then, as inflation fell and rates began a long, multi-decade descent, these same players received a second gift. Falling interest rates push up the prices of financial assets. Bonds held during the transition rose in value. Stocks entered a historic bull run. Real estate, after struggling through the early pain, became increasingly valuable under a regime of cheaper money and expanding credit. Volcker's shock didn't just defeat inflation, it cleared the path for a world where finance grew immensely, credit flowed more easily, and ownership of financial and real assets became one of the most powerful drivers of wealth. The age of the asset holder truly began. For those who owned these assets or moved into them at the right time, the rewards were enormous. For those who had been crushed by the initial shock, who lost homes, jobs, or businesses, the invitation to participate in that new world was far more limited. The adjustment that restored the currency's credibility also reshaped the distribution of wealth and power. There was another legacy, a playbook. Every major central banker since has operated under Volcker's shadow. Terms like credibility, anchored expectations, and doing what it takes became part of the standard language. Official statements are now measured and academic, filled with models and projections. But underneath the jargon lies a blunt question that Volcker answered once and for all. When inflation becomes intolerable, will policymakers accept immediate pain to avoid a deeper disaster later? His actions supplied a precedent. The answer can be yes. For decades, that precedent itself acted as a kind of invisible policy tool. Markets believed that if inflation dared to surge again, interest rates would rise aggressively. That belief kept behavior in check. The threat alone had power, but the world that inherited Volcker's template is not the world he faced. When the shock was delivered, overall debt loads were far lower relative to economic output. Globalization was just beginning to gather speed, creating downward pressure on many prices. Populations in developed countries were younger, with expanding workforces. The financial system, though imperfect, was smaller, less leveraged, and less entangled than the sprawling web that exists now. A Volcker-style interest rate today, numbers in the mid-teens or higher, would not simply cool an overheated economy. It would detonate a structure built on decades of cheap money. Governments rolling trillions in debt, corporations reliant on constant refinancing, households stretched to afford homes at already elevated prices, speculative structures piled on thin capital, all of it would be exposed at once. The playbook is admired. The cost of applying it at full strength now might be far more severe. Recent years have offered a small reminder of the pattern. After an era of near-zero interest rates and enormous stimulus, inflation surged again. Central banks, wary of repeating the 1970s mistake of delay and denial, began raising rates at a speed not seen in generations. Not to Volcker's extremes, but fast enough to shock markets that had grown addicted to free money. The language was familiar. Uncomfortable adjustments, necessary tightening, short-term pain for long-term stability. Beneath those phrases, the same logic was at work. Letting inflation run wild destroys trust in money. When forced to choose, the system will hurt borrowers, slow growth, and risk recession rather than tolerate persistent double-digit price rises. History does not repeat in perfect circles, but it leaves fingerprints. Volcker's fingerprint is visible every time a central bank chooses credibility over comfort. The question for individuals is simple and uncomfortable. What survives when that choice is made? Lives built on the assumption of permanently low rates are fragile. Heavy leverage with floating interest costs speculative bets that only work in a world of cheap borrowing blind trust that central banks will always rush to rescue markets. These are the habits that get punished when policy turns from accommodation to confrontation. On the other hand, real value proves resilient. Businesses that produce necessary goods and services, assets with genuine utility, and skills that generate income even in hard conditions tend to outlast shifts in rate regimes. When money becomes expensive, markets remember the difference between a story and a balance sheet, between promises and production. The deeper lesson is about awareness. Volcker's shock was not a moral parable about a hero and a villain. It was a demonstration of what systems do when faced with the possibility of losing control over their own currency. When the value of money is at stake, comforting illusions fall away. Difficult choices are made, and those choices are always paid for by someone. Inflation is not just a line on a chart. It is a battlefield where different groups fight, silently over who carries the cost of past decisions. The rate hikes that broke inflation in the early 1980s transferred that cost onto millions of shoulders, workers, borrowers, owners of fragile businesses, so that the dollar could be restored and a new era of financial expansion could begin. The next time phrases like taming inflation, bringing prices under control, or tightening financial conditions appear in official speeches, memory offers a quiet reminder of what those words have meant in practice. They have meant bankruptcies. They have meant job losses. They have meant a deliberate slowdown, even a recession, accepted as the lesser evil compared to losing control of prices. The system has shown that it can break inflation. The real question is never about capability. It is about willingness. Under what conditions will that willingness surface again? And when it does, which side of the adjustment will different people be standing on? There is no way to completely escape these storms. But there is a difference between standing directly beneath the falling weight and standing to the side, prepared, with an understanding of how the game is played. Volcker's shock is not just a chapter in monetary history. It is a warning label on the idea that money can be free forever without consequence. If this story opens a new perspective on inflation, interest rates, and who pays for stability, remember this. History has already shown what happens when easy money runs too long and the bill comes due. The choice is not whether that bill arrives. The choice is whether to meet it unprepared or to recognize its approach and adjust before the shock hits.